Hi there, I hope you are doing great. Thank you for listening in. Today, let us talk about using data and analytics to minimize credit risk and optimize lending pricing. In this post, we shall explore ways in which data and analytics can be used to minimize credit risk and optimize lending pricing in the lending industry. Credit risk, or the risk of a borrower defaulting on a loan, is a major concern for lenders. However, by using data and analytics to assess a borrower's creditworthiness, develop risk prediction models, and implement risk management strategies, lenders can reduce their exposure to credit risk. Additionally, data and analytics can be used to determine the appropriate interest rate for a loan, assess the impact of loan terms on risk and pricing, and implement data-driven pricing models to set competitive rates.
But Robert, what is credit risk? And why is it important to the lending industry?
Credit risk is the risk that a borrower will default on a loan, causing the lender to incur a loss. It is a major concern for lenders, as defaulted loans can significantly impact a lender's profitability. To manage this risk, lenders use a variety of techniques to assess the creditworthiness of potential borrowers, including reviewing credit scores and financial statements, and may also require collateral or cosigners to reduce their risk. It is important for lenders to effectively manage credit risk in order to maintain their financial stability and profitability.
Okay, I see now. What about the role of data and analytics in managing credit risk?
Data and analytics play a significant role in managing credit risk in the lending industry. By analyzing data on past loans and borrowers, lenders can develop risk prediction models that can help them identify potential risks and make more informed lending decisions. This can include analyzing financial data, such as a borrower's income and debt levels, as well as non-financial data, such as their payment history and credit score.
Tell me more, Robert. What techniques can I use for minimizing credit risk?
Techniques for minimizing credit risk involve using data and analytics to assess a borrower's creditworthiness, developing risk prediction models, and implementing risk management strategies. Using data to assess a borrower's creditworthiness. Lenders can use data to assess the creditworthiness of potential borrowers by reviewing credit scores and financial statements, and analyzing non-financial data such as payment history and credit utilization. By gathering and analyzing this information, lenders can better understand a borrower's ability to repay a loan and the level of risk they pose. Developing risk prediction models. Lenders can use data and analytics to develop statistical models that can help predict the likelihood of a borrower defaulting on a loan. These models can be based on a variety of data points, including credit scores, financial statements, and payment history. By using these models, lenders can make more informed lending decisions and better manage their credit risk. Implementing risk management strategies. Lenders can implement a variety of risk management strategies to further reduce their exposure to credit risk. This can include diversifying their loan portfolio, setting limits on the amount of credit extended to individual borrowers, and implementing policies and procedures to monitor and manage credit risk on an ongoing basis. By implementing these strategies, lenders can more effectively manage and mitigate the risks associated with lending. Setting competitive interest rates. Lenders can use data and analytics to determine the appropriate interest rate for a loan, based on the level of risk posed by a particular borrower. Higher interest rates can help compensate for the increased risk of lending to certain borrowers. Assessing the impact of loan terms on risk and pricing. Lenders can use data and analytics to assess the impact of different loan terms, such as the loan amount, repayment period, and collateral requirements, on risk and pricing. Implementing data-driven pricing models. Lenders can use data-driven pricing models to set competitive rates that reflect the level of risk associated with a particular loan. These models can be based on a variety of data points such as credit scores, financial statements, and payment history.
All right, Robert. What about optimizing lending pricing using analytics?
Optimizing lending pricing with analytics involves using data and analytics to determine the appropriate interest rate for a loan, and to set competitive rates that reflect the level of risk associated with a particular loan. This process typically involves analyzing data on the borrower's credit history, financial circumstances, and other factors that can impact the risk of default. By using analytics to assess risk and set appropriate interest rates, lenders can balance the need to make loans with the need to protect their financial interests. There are several different techniques that can be used to optimize lending pricing with analytics, including credit scoring. This involves using a statistical model to predict the likelihood of default based on the borrower's credit history, income, and other financial information. Risk-based pricing. This involves setting different interest rates for different borrowers based on their level of risk. For example, a borrower with a good credit score and stable income may be offered an interest rate that is lower than that provided to a borrower with a poor credit score and unstable income. Data mining. This involves using statistical techniques to identify patterns in large datasets that can be used to predict the risk of default. Machine learning. This involves using algorithms to analyze data and make predictions about risk and other factors. By using analytics to optimize lending pricing, lenders can make more informed decisions about which loans to offer and at what interest rates, which can help them to minimize risk and maximize profits. In conclusion, the use of data and analytics is essential for minimizing credit risk and optimizing lending pricing in the lending industry. By using data to assess creditworthiness, predict risk, and implement risk management strategies, lenders can reduce their exposure to credit risk and improve their financial performance. Additionally, data and analytics can be used to set competitive rates that reflect the level of risk associated with a particular loan. By adopting these techniques, lenders can increase their profitability and stability and better serve the needs of their customers. The potential benefits of using data and analytics to minimize credit risk and optimize lending pricing include increased profitability and reduced loan defaults, as well as improved financial stability and risk management practices.